update.
Hey Paul, how are you? And hello everyone, wherever you are in the world. Look, it's great to be part of the slightly new format show, Paul. And I wish I had something fascinating and truly insightful to say this week. What I will say is I'm going to do a tiny mini little look back on the Fed and the Fed announcements and also the post announcement conference that Chairman Powell gave, because I think it's really important and it's going to drive a lot of our thinking going forward over the next couple of years. So he reinforced his relaxed view about inflation, and he also reinforced the point at which he's going to think about raising interest rates, which is a very low rate of unemployment. I believe it was in the 3.5% mark. And if it wasn't in the 3.5% market, I had to hit some diversity targets before he'd even consider it. So I also am very interested in the way in which he expressed his opinion about the growth in the economy as well too, and what he's looking for there and where he feels inflation is going. So the basic Fed thesis right now is that the inflation is going to be a blip and it'll come back down again. Nothing to worry about, according to Chairman Powell. Well, the bond market seems to think slightly differently for that, because soon after the press conference, it shanked again and interest rates continue to rise. So this is a big problem which the Fed chairman has, because the bond market really essentially is the arbiter of the world in terms of what's happening. And so when you look at a 10-year rate and a 2-year rate, you can see a significant difference now. There's about between the 2 and 10s, I believe it's somewhere in the region of something like 150, 160 basis points worth of spread between the two of those. Banks will certainly be happy with that because they can make money, but it's also having that really positive yield curve is a sign that the market, so I always get my hands the wrong way around. So a positive yield curve is a sign that the market is reasonably well positioned right now, and there's not anybody needs to worry about. Now, that's all very well and good, but a rising interest rate environment, if you like that, we call it a bear steepener in bond land. Bear steepener in bond land normally isn't a great environment for growth stocks. So we'll see what the world's going to bring over the next few weeks. But I think the key message that I took out of it was he has no intention of raising short-term interest rates anytime soon. As a result of that, it wouldn't be a surprise to me if the dollar resumes its decline at some point over the course of the next few weeks. I think as a basic thesis, with a load of caveats as well too. You know, essentially the currencies have done tremendously well over the course of the last 4 or 5 months. They're due a correction, and they're all amazingly overbought. The Auss is overbought, the CAD's overbought. The euro maybe not so, because it's been correcting sort of for a little while now. But you only have to go and look around the markets and see some of the moves that have been taking place to say that they've actually got quite aggressive. And the same is true of the yen as well too. So the yen in some respects has been wildly has been working the opposite direction by falling quite considerably against the dollar. And so these are some of the core trends that we've got out there. So think sort of like CAD yen and sterling yen. They've been amazing trends. I'm not expecting those to continue. I think we're going to see a little bit of a reversal over the next few weeks. But overall, the long-term view is very much the case that the dollar is either going to be lower than where it is now, or certainly at the same rate in about 5 or 6 months' time. So that's how I view that for the time being, on the back of Chairman Powell's comments. And by the way, this is actually quite a departure for the Fed, right? He's essentially turned around and said, we're going to be reactive. We have no way that we're ever going to preempt anything, and we're going to wait till we see the data, and then we'll think about
Sorry, guys,
reacting.
is it just me or we lost Julian's audio?
Oh, I should be here.
Can everybody else hear Julian? Is it just my end?
Just you, mate.
I can hear him. Looks like Mike can hear him. Okay, back to you, mate. It was just
That's
me.
all right. So yeah, look, in terms of short-term trends, like I said, I'm looking at some of those interesting cross rates. So sterling yen, CAD yen for short-term corrections. I know they've been trending incredibly well upwards. So bear in mind, you know, you're trying to pick tops. So obviously always use tight stops, but I feel we've gone quite a long way in some of those who might come down. And I'll leave gold and oil to Ainslie and to the other folks who are going to look at those. But one thing I would do is just comment on There's a very good reason why you need to run stops in this market, stop losses on your positions, and you only need to look at the oil market last week to prove that that's absolutely the case. I believe it went down something like $4 or $5 in one day, which blew out days and days and days of trading. So this is going to be the way that the world is going to be working, I think, for the next few weeks, possibly even a few months. So we have to be careful out there and obviously make sure we got our stops in place. Paul, that's it from.
Cheers, Julian. Thank you very much. Always nice to get a macro view from you. Thank you very much for joining us today. Have a pleasant evening back.